Good morning, ladies. Nice to speak to you again. This is content that I'd like you to take a look at on the second lesson on Friday, the 22nd. I'll put this onto Teams. Excuse me, and hopefully you'll get some knowledge from that, and obviously we can discuss that during next week's tutorial, one-to-one, so to speak, on Teams. So we're going to be looking at productive and allocative efficiency this morning. And we have spoken about this before, but I think we probably just need to revisit it and just discuss it in a little bit more detail. So effectively, we're going to look at how you can distinguish the difference between productive and allocative efficiency, and also we'll distinguish the difference between opportunity cost and trade-offs. And these are all concepts I think you should have covered previously. I think productive and allocative efficiency you may have touched on, but we'll go into this in a bit more detail now. Okay, so without further ado, let's get on. So first and foremost, then we're going to look at productive and allocative efficiency, okay? And the areas we're going to be looking at include the following. So we're going to look at the distinction between allocative and productive efficiency. We're also going to look at the significance of the margin, and that will include opportunity cost trade-offs and allocative efficiency. So we'll look at all three of those areas, and the fact that when we're talking about marginal cost and marginal revenue, how that might drive decision making. We'll also be taking a look at how we can increase productivity by reducing average cost through greater efficiency and by improving certain areas. Now, to some degree, that will also take into account economies of scale, which I know that we have covered previously. We'll be looking at technology, how improving human capital might actually improve matters, and also the quality of management. And then we'll also be looking at how production levels might be matched more closely to consumer preferences, and that is all about market orientation. And again, we have touched on that previously, but we will look at that again. And then finally, we'll also look at how markets interact with one another and how one decision in one market might affect another, and that clearly would also affect the way in which we might choose to allocate resources to different markets. Okay, so that's basically what we're going to be covering in this presentation. So let's move on. Excuse me. So we talked about economic efficiency quite a lot over the past few months, really. And in this instance, we're talking specifically about where we are being economically efficient. Okay, so that's where we're achieving or managing to produce the maximum amount of products that we can at the minimum cost, whilst also maximising their benefit to society. So it's a sort of double-edged sword, really. It's not just about achieving the cheapest price or the cheapest cost of production. It's also about attempting to make sure you're matching society's requirements. So productive efficiency is very much about the efficiency of getting the most out of your inputs and producing the maximum amount of output at the lowest cost, whereas allocative efficiency is much more about making sure that we're producing goods that are going to match to consumer needs. So it's all about attempting to give some welfare gain, some societal gain and for consumers to gain some not just utility but some satisfaction from the products that are being produced. So just to refresh that, just to remind ourselves, then allocative efficiency is where we're looking at consumer satisfaction, and that is the thing that we're trying to maximise in the choice of production of goods and services that we as firms might choose to produce. So effectively, one good way of demonstrating this is the point at which the quantity supplied will equal the quantity demanded. So effectively, what we're saying is that suppliers will supply at a certain level, and if that's the point at which the quantity demanded is at the same level, then clearly that's showing that we're providing the maximum amount of customer satisfaction at a particular level. And when we talk about productive efficiency, that's where effectively we can't get any more output from the factors of production that we've got in place. So we're producing at the lowest possible average unit cost, and that's something we'll show graphically over the next couple of slides too. So bearing in mind this principle of average cost, basically that's where we're taking the total cost of production and dividing that by the units of output, and that gives us the average cost. And sometimes you'll hear that referred to as long run average cost, and clearly that is about trying to produce the maximum amount in the long term from the minimum amount of resources, and that's the point that we're trying to get to become productively efficient. If we look then at economic efficiency, then I suppose in an ideal world, if we are going to be truly economically efficient, we should be both allocatively and productively efficient at the same time. Now that, as we may have mentioned before, isn't necessarily a very easy position to find ourselves in, okay? And simply put, it's very difficult to achieve that, particularly in some of the imperfect markets, or the fact that in most instances we've got imperfectly competitive markets that we're working within. So to try and achieve both is sometimes quite difficult, as we'll see. We can use a couple of excuse me, a couple of types of diagram to demonstrate this. And the way in which we can show both productive and allocative efficiency, or where that point might be achievable, is by using production possibility curves, or sometimes known as PPS, production possibility frontiers. I think you'll probably be familiar with that, and I think when you see it, you'll see that you have actually gone through that previously. But it's a relatively straightforward concept and can show quite a lot, that as we'll see in a minute. So let's take a look then at productive efficiency. Now, productive efficiency is all about average total cost, okay? And average total cost, as we mentioned before, is effectively the total cost divided by the amount of output that we're producing. Now, in an ideal world, and if you think about it, as output increases, costs per unit should fall, shouldn't they? And that occurs because effectively we've got certain costs that are fixed. They don't vary with output, like rent, for instance. And obviously, when we spread those costs out over a higher amount of output, then we are going to reduce our average total cost. Now, in this instance, we're showing the point at which we are being productively efficient on the graph. So you can see that in the first instance, at a relatively low level of output, our cost of production are relatively high. As we produce more, as output increases, then for the fact based on the fact that fixed costs are then being spread across a larger number of items that we're producing, then effectively we're going to get this U-shaped curve. So we're going to get to the point at Q where we are actually being productively efficient because our average total costs are at their minimum point. Okay. Now, clearly, as time goes on, and due to the fact that we might get some diminishing returns to scale, and we might get some diseconomies of scale, then average total cost will tend to start to rise as output increases. Obviously, that's partly because as we're producing more output, we've got more variable costs. So that's clearly going to have an effect, but also there are some issues around diseconomies of scale where we're not necessarily producing the most out of the resources that we've got available to us. Let's have a look at the significance of the margin to this then. And obviously we've talked a lot about how important the margin, things that are happening at the margin of an economy are when it comes to making production choices. So this marginal analysis that we use, or the margin, is a fundamental thing to bear in mind when firms are making production choices. So again, we talked about this principle that that businesses will only produce and then will only choose an option to produce more if the marginal revenue that is generated from that extra item of production is going to be greater than the marginal cost. If that isn't the case, if the revenue that's generated by that extra item is less than the marginal cost, then every time that you produce another item at that point, then that's essentially going to mean that you're going to be losing money on that particular item. So in that situation, provided marginal revenue is higher than our marginal cost, that is going to contribute to profit, in that we're going to produce more revenue than it's going to cost us to produce that particular item. As soon as we get to the point where the marginal cost is actually greater than marginal revenue, then profits will actually start to fall. And clearly, dependent on your business objectives and what you plan to do as a business, that is obviously then going to drive your decision making in terms of whether you carry on and produce or whether you stop producing at a certain point. And in most instances, if we're trying to be productively efficient and not so much allocatively efficient, certainly productively efficient, then firms will choose to produce up to the point where marginal cost equals marginal revenue. And if you remember, marginal cost equaling marginal revenue is the point at which certain types of businesses would also operate. You remember which ones those were? Well, obviously the one that we talked about a lot is a profit maximizing company. Okay, so essentially, for as long as they will attempt to produce at a point where marginal cost equals marginal revenue, because that's the point at which they're still going to be achieving profit, and up to the point at which those two costs, that the cost and revenue are the same, you are still going to be producing profit for each extra item that you produce. So let's have a look at productive and allocative efficiency, and then also show how we can show this or show a number of different things on our PPF graph or our production possibility frontier or production possibility curve. Okay, so in this instance, we've got two choices. We can produce either good Y or good X, and there are a number of different points on the chart which we can actually then demonstrate what this shows. Now, if we take this first example, so any point on the PPC, this is the point at which our curve is on the production possibility curve. Now, that's essentially any point on this area here is where we are being productively efficient. Okay, so we're producing the maximum we can from the resources that we've got available, and you can see in this instance we've actually listed 4 points. Now, if we produce at A or B, we are being productively efficient. Okay, now dependent on the decision making and the preference that consumers may have, we may actually choose to either produce at A or B. But that's more down to the preference that a customer might have in terms of whether they would rather prefer good X or good Y. But we can also see in a situation here where if we were producing at C, then we are basically underproducing, because based on the resources that we've got available, we could be producing at a higher level either good Y or good X. So that would be a point at which we're underproducing and we're being productively inefficient in a sense. Okay, if we take the point at D, at the current point, with the current factors of production that we've got available, that is an unattainable point. We're not able to achieve that because clearly, in this case, we haven't got the resources to be able to perform at that level. Now, clearly, if we actually improve the level of supply and the productive capacity of our economy, then we should be able to in the future produce at D, but at the current point we're not able to do that. Now, the other thing that it shows quite effectively is this trade-off. So the PPC, this production possibility curve, shows the trade-off between two variables. Now, in this instance, we've listed them as good X and good Y. So we can either produce at this level of good X, or we can produce at this level of good Y, dependent on how we choose to produce. and the levels of resource, the levels of resource we have available have to be allocated in a certain way. And in this instance, you can see that if we choose to produce more of good X, then effectively that means we can produce less of good Y. And so there is always a trade-off, and again, it shows the opportunity cost. If we choose to produce at level A, then that means that we're producing high levels of good Y, but actually we're not producing as much of good X. And that's, again, another thing to bear in mind when we're looking at productive and allocative efficiency. Okay. Now, if we take this principle of allocative efficiency, then one of the main differences between productive and allocative efficiency is when we're trying to take into account the desires of consumers. Now, in this instance, if we take this example, if we take good Y, and that is the one that is in greater demand than good X, then the point at which we are being more allocatively efficient would be the point at which we are actually producing more of good Y, because there's greater demand for that. So at point A, we would be being more allocatively efficient at that point. Therefore, one could argue that allocative efficiency can be found somewhere on this production possibility curve, but it's very much dependent on the consumer preference. So in the situation that I've described there, where we've got a preference for good Y, or where consumers have a preference for good Y, then in that instance, obviously point A would be more allocatively efficient. Okay. So we're combining a couple of principles here. We're obviously talking about productive and allocative efficiency, but we're also showing how we can use the production possibility curve to show a number of concepts, from opportunity cost to underproduction, and also points at which we can't produce given the current level of factors of production that are available to us. Okay, so let's have a look and see then. I think probably the slightly easier one to understand is this principle of productive efficiency. But when we're talking about allocative efficiency, it's a slightly more tricky thing to get your head around. So let's have a look at when allocative efficiency is achieved. So that's the point at which, and it is slightly more difficult to identify, but allocative efficiency is the point at which we're trying to match consumer preferences to producer output. That's the point at which we're trying to give maximum utility to our consumers, but also producing at the most efficient point for our producers too. But trying to get both of those balanced is a slightly more difficult principle, as we'll see. So in essence, if we're talking about the point of allocative efficiency, what we're trying to do is to match demand to supply, to put it in another way. Now, clearly, in some cases, much as we know, we've talked about this market clearing price, this equilibrium price, where we've got demand absolutely matching supply. Sometimes markets aren't going to operate at that point. And that can be down to a number of reasons. Now, it could be down to excess supply. So we're supplying, or producers are willing to supply more than that's being demanded. So that can clearly mean that we're not going to be operating at a market clearing price. It could be that we've got excess demand. So demand is outstripping supply. And again, that might mean that that's skewing the market clearing price, and that obviously can be an issue too. Okay, now in essence, if we talk about that and think about how that might then affect things, to some degree, market forces will always try to push prices towards a market equilibrium point at which is essentially the quantity demanded will equal the quantity supplied, but that doesn't always work out quite as maybe we would want it to. However, when we're in a situation where we've got a more competitive market, where we've got choices of supply and also maybe variable price, then in that situation, more competitive markets are likely to help to achieve allocative efficiency, or getting closer to it. So just a quick test here, given what we've just talked about in terms of productive PPS or PPCs. And again, given this point of allocative efficiency, just have a go at answering that question. And I'll leave you to give that some thought and perhaps also explain why you've answered in the way that you have. Okay, let's move on and take a look at things that we can do to try to increase productivity in order to reduce average costs through efficiency gains. I'm just going to move my image over here a bit so you can see what we're talking about. Clearly, efficiency is going to be influenced by a number of things. Using technology is clearly going to have a fundamental effect. So if we're talking about automation or technological change, that is going to help to reduce our average costs of production. And also, if you think about that, if we're also being innovative, if we're coming up with new products and new process development based on the use of that technology, that might well mean that we are going to achieve high levels of profit, and in some cases we might choose to use that profit to invest in differentiating our products further in order that more people are going to want to buy our products and services. Other things that can help in terms of efficiency, clearly improving and investing in our human capital. So that might mean that we reduce the cost of labour. We might look at training and getting better educated workers that are employed. And clearly, if we can understand our job role and what we need to do to improve output, that's clearly also going to then improve overall productivity of an organisation. We might also find that if we improve the quality of our management, that might well mean that we're going to produce or come up with better decision making. That might then also mean that we're going to reduce waste, lower bureaucracy, lower costs, and as a result of that, that should help in terms of our productive efficiency, I suppose. Okay, so the other thing to bear in mind then, if we're talking about improving productivity, is to look at the points at which we can try to achieve this, and that could be down to the scale of the organisation, but also it's about trying to make sure that we get the most out of our factor inputs at the lowest possible average or unit cost. Okay, so effectively, if we can get to the point where a firm or a business is producing at the lowest point on the long run average cost curve, LRAC for short, then that means that we can't really produce in a more efficient manner. Okay, and if we get decreases or increases in the scale of production, then those average costs, those long run average costs, will start to increase. And we can show this in a number of different ways, but this minimum efficient scale principle that's mentioned in the title of this slide is quite an important one here. Okay, so this is the point. The MES, the minimum efficient scale of any organisation, is the scale of production where the long run average cost curve is at its lowest point. Okay. That clearly is quite an important principle. Okay, now that happens at low levels of output in relation to the size of the market, where there is likely to be a large number of firms. Okay, now in terms of this principle, then the MES, the minimum efficiency scale, is going to increase where there are fewer firms in a market, because those that are operating against less competition are probably going to be producing on a larger scale, and so we'll have much lower long run average costs, as we'll see. In those situations, clearly, if we've got not so much competition, but we've got lots of big producers in a particular market, then one could argue that creates a barrier to entry for new firms wishing to enter that market, because smaller businesses won't have the scale and the finance available to increase their scale of production to the point at which they can become a credible competitor to somebody maybe in an oligopolistic position, or where there is some sort of monopoly power within a market. So let's take a look at this minimum efficient scale and then try and draw some conclusions from that based on the way in which we might represent that in a graph. Okay, so as we can see, it's the same principle. This minimum efficient scale, this MES, it's the point at which our long run average cost curve is at its lowest point. Now you can see that is at a point where we've got increasing returns to scale, where essentially as we produce more, fixed costs can be spread across high levels of output, and so we've got this improvement, this reduction in long run average cost, to the point at which we have a bottoming out, for want of a better term, and we're getting constant returns to scale from this point here all the way to this point here. Now obviously at that point you could argue that that is a point at which we would be producing at our optimum level, anywhere where we've got these constant returns to scale and it's at the lowest point. We can then see that at a certain point the long run average cost curve starts to get starts to increase, and that's where we start to get decreasing returns to scale. Now in this instance, obviously that's going to have some implications, and in this case the MES of a firm will have implications to the degree of competition in the market. Okay, and we've talked about that previously, but in certain situations where you've got firms that are operating at a very large scale, they can clearly achieve the maximum economies of scale that maybe other smaller businesses can't do. But this principle of where the minimum efficient scale point is where it starts at this point here, where we start to get constant returns to scale. Now, the next thing to look at then is to think about how we might then, we've looked at that productive efficiency and shown that on the graph, and this minimum point of minimum scale. So let's just go back one. Minimum efficient scale is and can be demonstrated on our long run average cost curve diagram, but also we've got to think about the way in which we might be able to match production to the pattern of consumer preferences. Okay, now effectively in this situation what we're trying to do is if we're matching what we produce to meet consumer preferences, it's another way of saying we're becoming market oriented. We're finding out what customers want and then producing at a level to meet those requirements, rather than just producing what we're good at producing and then trying to sell it to as many people as we can. So this is very much an outward and very much a modern view, where we're looking at new product development, but we're not just producing what we're good at producing. We're looking at what products consumers want. So we're going to consult with them. We're going to use market research in order to find out what we should be producing to make sure that there is a need for the things that we're producing in our market. Obviously, on that basis, if we concentrate and spend some time trying to understand the needs of our consumers, we will then adapt our production of products to meet those particular needs, and that should be much more efficient and also much easier for us to then number one, produce the goods and services that people want, and number two, hopefully then be successful in terms of achieving decent levels of revenue and also then producing profit based on the fact that we've got our costs under control too. Now, in this situation, you could argue that to some degree that is going to reduce, not necessarily going to eliminate, but it's certainly going to reduce the risk of new product development, because if you've asked your customers, you've actually consulted with them, you've talked to them in focus groups, you've actually really understood what customers want and consumers want, and then come up with a product that meets those requirements, then you could argue that you're reducing your new product development costs and the danger of you not hitting the market in the right way. Now let's take a look then at, so that's really about market orientation and how that allows us to hopefully produce the goods and services that our customers want, and that is likely to be more allocatively efficient in that principle. Okay, now let's have a look at how where markets might interact and how that might have an effect. So we've got a situation here where we've got the market for apples and pears. Okay, so diagram A, shows the output of apples. In this case, is at Q2, but that is above the equilibrium price. So our equilibrium price is P1 Q1, but in this instance, we've got supply essentially outstripping demand, and so we're choosing to supply at this particular level. Now in diagram B, we've got output for pairs, where output for pairs is Q2, okay, and that's below the equilibrium price. Now one could argue that in that situation we've got a position where both markets have allocative inefficiency. We're not producing at the point at which we're satisfying consumer demand and also supply, which would be a market equilibrium price. In both cases, we've got a situation where we're not allocating our resources most efficiently. Now, if we were to reallocate our resources and then look at how we might move some from the production of pears to that of from that of apples to pears, we are going to increase the allocative efficiency of the two markets. Okay, and in this situation, if apples were produced at Q1, okay, and pears were produced at Q1, that would be achieving allocative efficiency. Okay, so we're taking resources and making sure that where we can, we match up the use of those resources to the demand that we're likely to find in a particular market. And just reiterating that, in this case, if we actually took in diagram A the market price as P2, consumer values, the consumers would value the last unit produced at Q1, where the price is P1. However, firms choose to produce at Q2. In that situation, consumers are not willing to pay that higher price, and so price will fall and firms will reduce supply, and that should or could lead to reallocation of firms' resources to another use, which is essentially what we just said when we were describing that information previously. Let's just move that up there a moment so you can see the text that we're going to look at next. So in this scenario then, in diagram B, let's assume that the market price was P2. If that were the case, consumers value the last unit produced at Q1, where the price is P1. Okay, and so if firms choose to produce at Q2, that clearly is not actually satisfying exactly what we want from the market, because in this situation consumers are willing to pay that higher price, and so the price could rise and will rise to P2, and firms will then increase supply. And that again would possibly lead to a reallocation of a firm's resources from one use to another. Now, that's all well and good to talk about in theory. Sometimes it's quite difficult to do that and see those trends in the information that's been provided to you. But obviously, in some instances, if you're a multi-product firm, you might choose, dependent on how real-time the information is that you're getting from the market, you might choose to reallocate your resources to better suit the requirements of your customers, and clearly that would be a very good way to work. Okay, so another little test for you. Okay, so scenario here talking about the supply of organic produce, and then explain whether you believe that the market is working most efficiently, and also try to describe this principle of allocative efficiency given the information we've just gone through on the previous slides. So I'll leave you to give that some thought and get your head around that, and obviously if we need to, we'll talk about that more when we get to a tutorial session later on in the week. Okay, so basically what we've covered in this presentation is all of the areas we said we would do. We've looked at allocative and productive efficiency. We've also looked at the significance of the margin. We've shown opportunity cost trade-offs and allocative efficiency by using the PPC, the production possibility curve, or the production possibility frontier as it's sometimes known to. And in this instance, we've also looked at ways in which we might be able to increase productivity in order to reduce average cost, and obviously by producing more efficiently, then clearly that hopefully is going to allow us to, number one, produce at a productively efficient rate, but also when we take into account customers' requirements and their level of satisfaction and utility, we might also be trying to influence allocative efficiency too. So where we're trying to match demand for goods and services with the supply of those services too. We've shown the way in which we can actually use that to demonstrate how we could meet consumer preferences better if we became more market oriented as an organisation, and also then taking a view where markets clearly will interact with one another, and dependent on how much information you've got about the way in which markets are moving, you might choose as a business to reallocate resources to try to achieve both productive efficiency, i.e. your lowest long run average cost, but also allocative efficiency, where essentially you're trying to provide the goods and services that are going to give the most utility to your consumers. So thanks very much for listening. Hopefully that all makes sense, and we'll catch up in the next couple of days with a one-to-one tutorial on Teams. So I'll take care, and I'll speak to you soon.